Vice Chair of the Federal Reserve, Jerome Powell's right-hand person, just spoke, and we should analyze what it was that he said and the direction that he thinks rates will end up trending in. It'll be very important for us to pay attention to, especially since the next Fed meeting is about 5 weeks away. We got CPI data coming out in 2 days. I'll be live streaming that. That'll be very important. And basically the day that Bill Ackman went short treasuries and we started talking about the trade potential of going long on TMF, the 3x leveraged treasury yield fund, we started seeing treasuries actually bottom. So in other words, the day Bill Ackman goes short, they seem to bottom and they come up from there, which is great, especially if you're investing in TMF. Now, we've been paying attention to TMF here as a trade. We've been talking about this Thursday, Friday of last week. That was the bottom, and we're already up on TMF. By the way, if you want more of this kind of discussion, whether it's fundamental analysis or trade analysis, real estate analysis, income analysis, you name it, check out those programs on Building Your Wealth, link down below. But what's more important is talking obviously about what's on my iPad. Oh yeah, and it's of course Tiffany, the woman behind the viral "that mother effer back there is not real" meltdown video. She's finally been identified as a marketing executive from Dallas. But instead, something to pay attention to when it comes to actual finance is the 5-year forward break-even chart. Ah, yes, more confusing charts, right? Well, look, this is the one you're used to. It's the 5-year break-even. As you can see, it's about 2.27. That's the average expected inflation rate over the next 5 years. We'd like to see that around 1.8, 1.7, so the Fed can finally cut. The 5-year forward is a way of saying, what does the market think inflation will be in 5 years for the next 5 years going forward? And that just had a little bit of a pop. So we're going to want to pay attention on to this chart, because this pop on that right side is the highest pop we've seen in the last year. So we'll really want to watch that a bit. And then, of course, we've seen the 10-year Treasury yield finally come down ever since Bill Ackman shorted it, which means prices have gone up. So Bill Ackman, once again, a bottom signal. Michelle Bowman, who's a voting member of the FOMC, does indicate that rates could trend up again, that we might need to see additional increases to get to 2%. But she, in my opinion, doesn't matter as much as John C. Williams, the chair or the vice chair of the Federal Reserve and the president of the Bank of New York. He argues that, look, we're clearly not in a recession, and supply and demand are finally moving closer together, that we still have some excess demand. However, we seem to have rates now where we are on the path to 2% inflation. The reason he argues this is for 3 reasons. Number one, he uses multivariate core trend inflation. It's basically a fancy way of saying his Federal Reserve Bank thinks that inflation, including core and sticky inflation categories, are clearly trending down. In fact, multivariate core is sitting at 2.94%, which is a way of saying that we're almost at 2% for that core inflation. Like we're getting there. Now, that's a little different from core PCE, which is still sitting at 4.1%. But what they look for here is specifically the sticky categories and those dangerous ones. And those are really trending down, which is great. To some extent, you're finally seeing a little less hiring in leisure and hospitality as well, which is potentially a sign that maybe those sticky parts of inflation are finally coming to an end. So those will be important to pay attention to, along with housing disinflation. The San Francisco Fed, maybe because it's San Francisco, but then again, they're applying this to the entire United States. They argue that shelter inflation is not only expected to plummet between now, where we are now on this chart is really sitting right around here, is not only expected to plummet towards 0 over the next 12 months, which is a really great disinflationary headwind, but it might actually end up going negative. Now, this is just a potential path, so we don't know if this is obviously guaranteed to happen. We'll see. It's just a forecast, and forecasts are notoriously wrong. But the point is, John Williams argues that inflation is on the right path, and quite frankly, we might not have to raise rates anymore. In fact, he says we're definitely at a restrictive level. We are well above what neutral is, and we probably don't have to talk about raising rates anymore. Instead, we should just talk about how long are we going to keep them there. He does indicate we expect to cut rates next year, potentially the year thereafter as well. And that's all going to be dependent on keeping real rates steady. because as John Williams here mentions, they don't want to do too much. And that's one of their concerns, is they want to bring this inflation down without doing too much. Now, of course, a lot of us don't necessarily believe them, but as John Williams says, things are moving in the right situation, still have pretty strong demand, and wages should grow with productivity. And hopefully productivity continues to move in a positive direction to where we can finally bring the economy in balance and not face any longer-term issues of more rate hikes or recession. That's still possible and potentially likely to happen based on the inverted yield curve. But when it comes to the Fed, they're indicating they're at a restrictive level, and now instead, they don't need to take immediate or specific action, as they say. Instead, let's just collect the new data that comes out, like CPI, in 2 days, which is great. And it's one of the reasons why we only have about a 10% chance now of seeing a rate hike in September from the Fed. In other words, we could potentially be done. I do think it's interesting that already being done with rates, and this is a red flag, already being done with rates, they think, Mr. Williams here, thinks that the unemployment rate may rise to something like 4 to 4.5%. This is a problem because historically, when the unemployment rate rises 1% from something like 3.5 to 4.5, it usually goes on to go up another 1%, which would mean we'd actually be going up to about 5.5% unemployment. And that's probably going to be where we wonder, is that a recessionary time? Or are we really cutting back to zero rates there? And then, of course, the bears argue that's it. We go back to inflation. Of course, I think we really only go back to the serious inflation we had if we run the money printer as quickly as we did last time. We'll always be running the money printer. Don't worry, like fiat will collapse at some point in the future, but it might be hundreds of years before that actually happens. So can't really play the, oh, it's going to collapse tomorrow game. You gotta make money while you can and play the game. Anyway, obviously indicators suggesting demand still exceeds supply, and that's why they want to keep things tight. But they're pretty happy with the liquidity buffers they have. That was a big bear argument that fell apart earlier this year. Not only that, but they talk a little bit about some risks in commercial real estate, though they think those are a little bit more constrained. They talk about this potential fear about re-acceleration, but not being as big of a fear as potentially over-tightening. They actually, in this interview, talked more about the fear of over-tightening than the fear of re-accelerated demand. Now, we could look at the Fed and go, look, this is all BS. You can't trust these people as far as you can throw them. But it is worth seeing where their heads are. That, yes, in the meantime, while the stock market is trending down and you've got Disney creating this converging downward pattern, which potentially suggests you'll get sort of a pop tomorrow on earnings or not, because maybe they'll miss on cloud again. Who knows? Maybe everybody dislikes Disney. Point is, it's very likely that the sort of correction that we're seeing now in the S&P 500, you zoom out to the weekly chart, is actually just a kind of healthy correction that you sort of need, and that is a way to set up your next potential rally. You could almost say the same thing about the Qs, although the Qs have barely even shown any correction here. So, a lot of people sad about this, but we've barely moved. It's really, though, that most stocks have capped out, especially around when you look at Tesla. Most stocks capped out right around July 19th. So we're at about a 3-week-ish sell-off here. I mean, even look at a company like SolarEdge in the total dumps since about July 19th. It's really where a lot of things capped out. Could create some buy-the-dip opportunities in the short term, but it does appear that if we get a positive inflation read here on Thursday, the Federal Reserve is basically telling us we're done. We want to be careful about overcorrecting. And of course, the big risk is unemployment being such a lagging indicator that we do end up falling into a recession, as even one of the people that's like, hey, things are going good, is saying, hey, unemployment's probably going to go up another whole percent. And again, once it starts going up 1%, it's hard to just get it to stop at just 1%. So those are some red flags going forward. Not sure if they call for sell everything and buy gold, but it does seem like TMF could be a valuable trade. So if you think treasury yields have topped out, check out TMF as a potential trade. Drop your information over at househack.com if you want to be notified when we are raising money from anyone, non-accredited investors included. No real qualifications, which is great. Wait for that, stand by. Thank you so much for watching, and we'll see you in the next one. Goodbye. Now, I want you to know this, when it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by artificial intelligence. If you can master AI by starting on the ground floor, let's go.